And we are live. Let me just give this a second to sync up and have everybody load up here. There's everybody. Welcome, everyone. Welcome. Say hi in the chat if you can hear me. Awesome. Okay. Now, welcome, everyone. Good afternoon, good evening, or good morning, depending on where you're joining us from. And welcome to another episode of the AI Circle brought to you by the iFlip YouTube channel. I am your host, Aaron Yoon, and joining me is none other than our Chief Investment Officer, Kelly Korshak. Welcome, Kelly.
Hello, Aaron. Hello, everybody.
Awesome. We have Shelly Martinez joining us. We have Growth Choice. I'm assuming that's a business name. Joining us, and of course our very own Lee Gearhart, our director of sales, is also joining us from the audience. Great, good turnout tonight. Okay, now before we can do any of this fun stuff, we did have an announcement today. We have a lot to cover. We do have to go through the disclosures. If I can pull that up real quick. I don't know why this won't. Give me 1 second here. I know you're all eagerly awaiting the text on the screen. There we go. Disclaimer: Flip Investor Incorporated and iFlip Financial Services are not financial advisors and do not make buy, sell, or hold recommendations on any financial instrument. This presentation is for educational purposes only. Unique experiences and past performances do not guarantee future results. All financial investments involve risk. You should speak with your CPA or financial representative to ensure that the iFlip portfolios that you select are suitable for your investment profile before trading in a live brokerage account. Now, with that out of the way, I'm going to pass it back over to you, Kelly.
Thank you, Aaron.
We had an announcement today, and we were just talking about how the AI is interpreting it. The AI and the algorithm are interpreting it almost in very different ways than they have been before. So very interesting time right now. Please, bring us up to speed.
Sure, of course, Aaron. Yeah, we were talking, Aaron and I, briefly before we got on this webinar about what has changed since 2 weeks ago when we last had our AI circle. Over the last 2 weeks, and today being in a special instance because today the Fed raised interest rates again another quarter of a point, putting Fed funds between now 5.25% and 5.5%. So since the last time we've been on the show, that has changed, and that of course just occurred today. But it really didn't hurt the market because despite raising interest rates, the Dow Jones was higher. The Nasdaq, of course, did lose something today, not much. And the S&P, again, similar, flat on the day, just down 71 points, literally flat on the day, down 0.02%. What's going on, I think now, based on what I'm seeing, is this. The AI has had a lot of data over the last year and has kept us out of the market, and we've had a good run in the S&P. The AI has not been so strict. However, thank goodness, on some of our other portfolios, which of course are the balanced and the aggressive and the conservative, those portfolios are more dividend orientated. If you're offering dividends, we must have more exposure to the market. So AI will not impact that nearly to the degree as it would, for example, the S&P 500 Spider. This all being said, right now I'm noticing that some of the clustering, a term I won't try to explain too deeply, which is how the data that is being fed to our machine learning will interpret the information such that it can change a signal from flat to long. That appears to be changing, and I think will change probably by tomorrow, despite today's interest rate increase. What does that mean? It means simply AI will no longer be a hindrance, very likely, in the ownership of the S&P 500. That being said, algorithmically, and I'll explain the difference, algorithmically, we would also be out of the market. So now that the AI wants to likely say that we could be in the market, the algorithm says we shouldn't be in the market. And at the end of the day, if the algorithm is long and the AI is out, we are out. But if the AI is in and the algorithm is out, we are out. We need to have the AI and the algorithm in to be in, or the algorithm is in and the AI out means we're out. So think of it as those true false things we learned in high school. So true and false are false, false and true are false, false and false are true, and true are true. So it comes to something like this. And a matter of fact, that's exactly how it boils down to when it comes to making the decision to be in or out. What does that mean for everybody on the screen? If you could see my screen, I will make this bigger so you can see it. We're looking at a chart of the S&P 500. I'm going to zoom it in. And if you look at this, I can tell you now, folks, that if this market were to dip about 66 points in the S&P 500, we would be in. That equates to approximately 1.5% dip we would buy. So that is something for everybody to take note of. That would make a big a choice for us to be long the market, likely going into September, where we wouldn't get a change in the AI throughout the rest of August, which is approaching very shortly. So today, let's just look at the market action. I think most of us know that the Dow Jones has increased like 12 days in a row, as we can see right here. This is actually putting the Dow Jones at its 2 standard deviation upper band. What does that mean? Nothing. A lot of people use these things as support and resistance. However, markets don't really think that way unless the indices are very broad. But if we look at the Dow Jones, it's added 2 standard deviations above a long moving average. These are things most people are aware of. The NASDAQ is at the same. The S&P 500 is above it. That's why we will not, one of the reasons we would not buy. The Russell 2000 is right on it. And in context, the Russell 500 is still way off its highs of 2001, way off. So this has not participated. However, this is something we've been talking about for many months now. The fact that 7 stocks brought us all the way up. However, these 7 stocks do not exist in the Russell, and those stocks have no influence on it, and that's why the Russell has not rebounded. So we're still saying that the market, although it's very thin in terms of what brought it up, nonetheless, it is up. And now, at least in the terms of the S&P 500, it is starting to drag begrudgingly other stocks up. Let's take a quick look at the banking stocks. Remember how bearish everybody was on the banking stocks not too long ago? We had the default on the banks. Let's take a quick look at Bank of America. So again, all stocks went down through 2022. We know that. But if we just look at 2023, Bank of America is flat. This was part of the banking crisis here, this move down that occurred in January and February. However, now, apparently everybody believes the banking crisis is over. And I actually think it is. There may be some more defaults coming up, but nonetheless, we now know that the Fed will bail them out. So the banking stocks kind of look decent in here. This is an example of Bank of America. Let's take a look at Goldman. Look at Goldman. It has actually had a very strong rally also over the last 12 days. That's why the Dow is up. Let's look at JP Morgan. Look at this. Really moving up also over the last 12 days. I think this is just a function, everybody, of what do we buy now that we're convinced that the market is going higher. So they figured, oh, the banking stocks are undervalued, so let's buy those. Even Charles Schwab has done very well. Look at this gap higher. Charles Schwab looks like it wants to at least go to $72 to $76 a share. So it's at 66 now. For people that are interested, that looks like to me at least a 15% return that I would expect to happen probably before the end of the year. That's something interesting to look at. Let's look at let's switch over to oil stocks real quick, because most of us have influence in a lot of our stocks. are in oil, like our red oil portfolio or some of our other portfolios, they all have some oil components because we generally like oil. Exxon, I don't need to say, it's a stock that offers and recently, a few months back, raised its dividend. It's at the lower end of a range. Oil has almost hit $80 a barrel today. I suspect that Exxon will stay in here and maybe rally a little further, maybe to 115 or so, representing approximately a possible 10% gain sometime in the fourth quarter. That looks pretty positive. Let's look at Energy Transfer. Almost another new high, with the old highs were at 1356. We're just 40 cents off of it today at 1316. So we're very close to all-time highs. And remember, these things are paying very large dividends. A dividend will come into this stock here of 31 cents a share for just one quarter. So we multiply that dividend of 31 cents, everybody, times 4 for 4 quarters. And that number is $1.24. You have a $13 stock paying you $1.24. And I don't need to tell you, that's a very good dividend, just under 10%. And guess what? It's moving higher. Expectations for this stock are probably somewhere around the numbers before COVID, which we're close to. But I would expect this stock to possibly go between $16 and $18 a share, $5 a share higher. That's a good move on a $13 stock, plus the dividend. One of our favorites also is All Plains American, doing pretty much the same thing. Here was COVID, really hit All Plains. However, All Plains, look, if it's all boats are equal, I think All Plains can go to 22. That's why we have red oil. 22 means literally almost a $7 move from here on a $15 stock. That's a 50% gain. And you know what? It's paying just around 7.5% dividend currently. So these are stocks we really love. They're very strong and people are buying them. Let's take a quick look at the cruise lines. Again, something we pay attention to because, again, since COVID, which now is a rearview mirror for, thank goodness, most of the world, we see it sits here today around $20 a share, $20.77. However, obviously before COVID, they were 53. These are stocks that if we do have a recession coming up, they will have trouble struggling. However, if you think over a 5-year term, just think this way. Putting portfolios aside, if you have a $20 stock and you think over 5 years it could be a $50 stock, that means that literally it could go up 150 cents, 150%. 150% divided by 5 years, that looks like 30% a year to me. That pays no dividends, but 30% a year is something that we all must consider as a long-term hold to assume that the travel industry, and particularly these cruise lines, will recover. And this is also true of the case of Carnival Cruise Lines. Let's take a look at that. A very similar pattern. Carnival sits today at about 1767. And even though they were going down into COVID, it would be fair to say that if we just recover into COVID, it could at least be $40 a share. And that would be literally just after COVID hit. That to me is about also at least a 100, maybe 120% gain. Say it's over the next 5 years, very similar returns, approximately 25% a year. These are stocks I like, and they are in a lot of our portfolios. Once they're in, they get managed, of course, by algorithms and machine learning. But nonetheless, these are very impressive stocks to own, and I think all people should have some exposure. To a lesser extent, which we also have in our portfolios, is AT&T. You'll find this in the conservative and in the balanced. AT&T is having a lot of troubles, folks. Yes, it pays a dividend, but it is a stock that is definitely in trouble. It's one of our lesser picks. However, again, the dividend has a value to it for new customers. The issue with AT&T is it's debt laden. And until it offloads, for example, companies like DirecTV and things like this, I think AT&T may struggle. It may grind higher. But if it does, it is only a sell, and that's the way the machine learning and algorithm will look at it. So these are things to also understand. Let's move over to a couple of the high big techs. And I think we all, if no matter what chart we pick, they all look good. Here's Apple. The move this year is pretty much nothing less than amazing, making new highs and a $3 trillion evaluation in 2023, straight up. The technology stocks alone, of course, have hauled literally the market up. Apple now represents as much as 7% of the S&P 500. Nothing like this has ever occurred historically. This is kind of an amazing thing to watch one stock, literally almost one stock, pull the entire market up. That is a phenomena that is unprecedented. Microsoft had a very tough day today. If anybody is watching, it was down 3.76%. But like anything else, this market always likes to recover. People want to own it. People have cash and they're throwing it in the market. Let's look at, no matter what stock we look at, here's Netflix moving higher, Meta moving higher off its highs, but just barely. Google, brand new high, very big day today, up almost 6% at $129 a share. Again, another stock that has moved from $90 to $130. Hey, that's a $40 move on a $90 stock that's almost up 50% on the year. An amazing move. Some of these stocks, as you know, are in some of our portfolios, like the balanced. And so keep this in mind. These are the things that smaller positions have allowed those portfolios to do very well this year. Let us move into one other thing I think is significant. Let's look at the dollar and keep an eye on our currencies. Here is the dollar index. Again, the dollar hit its highs in last September, October of last year when the market hit its lows. The dollar has come off and the stock market has gone up. Kind of makes sense for most people if you think about it. If the dollar is cheaper, it allows foreign assets to come to America. What do they buy? Well, they buy our real estate, but they especially buy our stock market. And especially now, they even can buy our bond market because we're paying higher interest rates than pretty much everywhere else around the world. The euro, I think everybody knows too. This has made it, the euro dollar right here. The euro sits now at $1.08. So again, coming off of a low of 98, it's up over 10%. The dollar is definitely weaker, and I'm not sanguine about owning the dollar going forward. This tells me that this should add value to the stock market. And so guess what? This is part of something the machine learning does. It looks at these things and tries to see if it can find relationships to own stocks as a function of dollars. So, and it's a long thing. I'm trying to figure out how much time I've already spent, about 20 minutes. It's amazing how fast the time can go. But all in all, let's look at where we think what we talked about here is just a recap of what the market has done. Let's kind of think of this now going forward as what does this mean at Flip? Because at the end of the day, that's really what we care about. So this year, my personal opinion has been wrong, but the good news for us is that my personal opinion doesn't count. So most of our portfolios have done well, but some of them, of course, have underperformed because, again, the machine learning, which looks at many different aspects, was not clairvoyant enough to recognize that the 7 stocks could literally haul up an entire market. So let's talk a little further to that before we get into today's trivia question. At the end of the day, something really unique is going on that is very difficult for anybody to explain, and pundits are confused, as well as very large hedge fund managers. Most hedge fund managers have had losses this year or very, very modest gains at best. Why is that? It's because they're looking at the same thing we do here at iFlip. They are looking at raw data, and the raw data does not point to the surge we've seen in the markets. And that is because the raw data, interest rates, credit cards, credit expansion, are all dangerously in peril. What we're noticing is even though credit has expanded, the credit defaults have expanded even more. We are now at the point where people are using credit cards to pay off mortgages. Remind you again of that. People are using credit cards to pay off mortgages. Now, we all understand that that is not a good recipe on a go-forward basis. There will be a breaking point. We don't know where it was. I suspected this would have occurred somewhere in the second quarter. It didn't. We're now in the beginning of the third quarter. So, what are my expectations? My expectations are that the AI, although it will make likely a signal to go long, wouldn't be surprised at all to see that that turns around. The data is just minimal for being long and predicting higher prices. That doesn't mean we don't take the signals, we do. However, when you see this kind of data, it is very difficult to be optimistic the stock market. So what we do is we go into the stock market without optimism. So people that buy and hold, they don't look at it as optimistic or they don't look at it as pessimistic. They buy and hold and they go through the ups and downs of the markets. In our case, we will probably get long over the next week or so and then look for something to happen in September as we get into generally one of the worst months of the year. And I suspect that the AI would make a very quick turn and turn us back out of the market. But in the meantime, there might be 5 or 6 weeks that we can participate somewhat, earn some money in some of our more narrow portfolios, and then we'll see where the thing goes from there. So I think that, Aaron, leaves us about 7 minutes to do trivia and answer some questions.
Yes, we actually did get some questions from the audience. I'm just going to go in order here. We did get a question from Domino 05 Full, asking if did the yield curve go back to normal, or is it still reversed?
It is still inverted. And that is one of the things, again, that the machine looks like. So, for example, it's inverted. The long 10-year Treasury bond or note is sitting at about 3.83 the last I looked a couple hours ago. However, Fed funds rate, which is essentially a 3-month T-bill, look at it that way, is at 5.5%. So you got a 5.5% short-term 3-month T-bill, and you have a 10-year note that'll pay you less than that 3-month T-bill. So no, the yield curve remains inverted, and an inverted yield curve every time in history led to a recession.
All right. I hope that answers your question, Domino. Hope that doesn't scare you too badly, but these are just facts of the case. All right. We did get another question from, I hope I'm gonna butcher this name, Srinivas Chaganti. Hopefully that's the right pronunciation. Where are the opportunities in the current market, or should I go short? Now, I do want to preface this. We can't answer this question directly. As I said in the disclosures, that would constitute advice, but we can share what iFlip's going to do, like the AI is going to do, and we can share what Kelly's opinion is.
Well, thank you for saying that, Aaron, but I can opine on this question, and that's all I'm doing. But
right,
this market has a lot of momentum at this time. I think everybody would agree there is momentum. We have, if you noticed when I was going through some of those charts, that a lot of the technology stocks have actually just came off their highs by barely, small amount, maybe 4 or 5%. Not even that, 4%. But that didn't stop the Dow Jones from rallying 12 days straight. So those things, these narrow indices have kind of gone to their highs, even though the technology companies have somewhat backed off. Noticing Microsoft today. So going short, I wouldn't do here. I like to go short. As you know, that Flip will not do that. Flip will just get you out of the market. However, I would admit that I will definitely personally be looking for a short position sometime at the end of August, maybe September. But being short is a tough job. And where do you put that short on and how do you call it off? I'll give you one final thing that I'm going to show you before we answer another question, very likely.
Yep, there's one
So,
more.
for example, let's take a look at Meta as an example. Meta hit a high of 319. It's down $20 to 298. So that means it's off $20 off of 319. What is that? About 6% on that stock. The way you would short anything is to say, okay, if I sell it here, I have to risk a new high. So that means I got to risk about 7% on the trade. Now, these trades are best done with options or futures. And they're best done if you have multiple time frames to look at, so that you can use a shorter term time frame to hopefully get you out before you have to risk, for example, the entire 7%. Now, where are the opportunities to go short? I really don't like to opine on that because that takes a lot of timing and it means definitely a bigger level of risk than you might have going long and holding a trade. I think the opportunities remain in oil. So any oil stock right now represents a commodity that if the market turns into a recession, part of that recession would be caused by higher oil prices. The other thing that it could be caused by is wage price inflation, which now we're, by the way, starting to see. So my instinct is some of the oil stocks can be taken. Any dip on those, I think, are good values. And my classic example would be PAA for All Plains American. And here's the other one, banks. Banks are, in many cases, if you look at Bank of America or even Goldman Sachs, which is generally the best of the best in the banking sector, those are off their highs. These are obviously our longtime good stocks. And if you're going to take a position that might be able to manage through some bad times, I would look at the banks. And you can just kiss goodbye, folks, the idea that there's going to be another banking crisis. That is over. That doesn't exist any longer.
Yeah. Last question for the evening. And before we get to a very interesting trivia question, Mario Romano asks, favorite cruise line ticker if you had to just pick one? I think just the ticker is fine because we do have to get to the trivia.
I'd probably pick either Carnival and or Norwegian, and that's the reason I keep an eye on them. I like these the best. There's others, but I like these because you just see the relative value. I keep an eye on them. They're relatively inexpensive stocks. No cruise is going to pay you a dividend. And these are things that you can't argue that if you put $100 down today and you think it could be $250 5 years from now, that doesn't sound like much. But guess what? Nobody in the stock market is trying to make $150 unless that's all you have. What you would want to do is, if we have a portfolio of $100,000, it wouldn't be such a bad idea to buy something 10% of a portfolio with that big of a makeup on something that is so deeply undervalued.
Right. So hope that answers your question, Mario. And fortunately for you, those are a couple of ticker symbols that we talk about fairly frequently on the AI Circle. So make sure you like the video and subscribe to the YouTube channel so you don't miss any of the other updates where we talk about those stocks. Now, let's get right into the trivia question here, folks. The trivia question.
Don't look it up, folks.
Yeah, no Googling, because this is really fun. Okay, I'm just gonna go right into it because we are pressed for time. Whose face was on the $100,000 bill? Okay, now this is not a typo. When I was first given this question, I was like, wait a minute, are you sure $100,000 bill? Like I bewildered as well. There used to be a $100,000 bill. And so the question is, whose face was on the $100,000 bill? Now you might be wondering, wow, is this even real? Kelly, could you tell us what's the deal with the $100,000 bill? Like, where did it come from, and how did it come to be, and why doesn't it exist anymore?
Well, I think we can kind of understand why it doesn't exist anymore, given the amount of fraud that occurs on a credit card. The
Right.
$100,000 bill came out in 1934, and they printed apparently about 42,000 of them between 1934 and 1935. The reason for a $100,000 bill at that time was cash. So a lot of times, if there was a large transaction and people wanted cash, and by the way, didn't necessarily trust the bank. Remember, this is the 30s. We're in the Depression. They printed these large denomination bills so as to transact in large capital takeovers. So, for example, back then there was companies like General Motors or General Electric. They wanted to buy something. There's no wiring, of course, at that time. And banks were distrusted at that time because remember, there was a run on the banks. So the Fed, the Federal Reserve, and the Treasury allowed a $100,000 bill to be printed so that some large transactions could consummate easier and safely. They were basically pulled out of circulation in the 60s, and now all of them are held by whatever is left is held by the U.S. government itself.
That's fascinating. I could use one of those. I could use one of those bills right about now.
I'll take 10.
Yeah, I'll take a couple of those, please. So we did get a couple of answers. I will give you another second. I mean, I think people are really trying to are spending time Googling it maybe or something like that. But while we're waiting for some answers, because I'll tell you right now, we don't have the correct answer yet. Just hint, hint. What is the prize if you get the correct answer? It is a $25 Amazon gift card, because you know what? Let's be honest, that might as well be cash, right? And we also have the opportunity for you to maybe double that. We'll give you another $25 Amazon gift card if you're the winner and you post about your lovely time at iFlip AI Circle and your winnings. Okay, so that you have the opportunity to get up to $50 in Amazon gift card. And we did get the correct answer finally, and it comes from the same person that submitted a question before. The correct answer is. Oh, he admits to cheating here. He admits.
Thank you for admitting it.
But the winner is actually Srinivas. Hopefully, I'm saying that name correctly. That's the first person who entered the name correctly. It is Woodrow Wilson. Woodrow Wilson was the face on the $100,000 bill. Congrats to our winner. You will get a $25 gift card if, right, there is a qualifier. It's not enough that you just got the right answer. You do have to show us that you are invested in at least one iFlip Smartfolio. So how do you do that? You have to show us either a screenshot of your account or just send us your account number and email that over to mailbag@iflipinvest.com. All questions and comments and feedback are about all of our YouTube shows. Go to mailbag@iflipinvest.com, including prize verification. So show us your account number or your screenshot. Show us which Smartfolio you're invested in, and we will reply with a email gift card, because it's convenient. It's more convenient that way, from Amazon in the amount of $25 with instructions on how you can double that as well. So congrats to our winner. That about does it for tonight. If you enjoyed this content, folks, consider liking and subscribing to our YouTube channel. We are on Wednesdays, every second, third, and fourth Wednesday of the month, with live shows to interact with you and answer all of your questions. That means that next week is a break week for us. It's the first Wednesday of August. So we will see you in 2 weeks back with Kelly for the next episode of the AI Circle. For now, we're signing off and saying good night, everyone.
All the best. Take care, everyone.